Welcome back, it's JWalter here. Even though we're starting to see some early signs that our housing market in the US is starting to slow down, given of course because mortgage rates have increased over 2 percentage points so far this year, and also we have record high home prices right now, we're also starting to see some resiliency in prospective home buyers as well. This is because according to the Mortgage Bankers Association that was just announced today, the number of people submitting loan applications to buy houses right now has increased for 2 consecutive weeks. So in today's video, I'm going to be sharing all the latest data with you guys. So hope you guys get a lot of value out of today's video. And if you do, of course, please hit the like button. I greatly appreciate that. So this is according to the Mortgage Bankers Association, or the MBA. I talk about them frequently on the channel. If you're a subscriber, they actually just announced this report here on the 11th. So basically every single week they announce what the changes in mortgage applications across the United States. So mortgage applications would be for loan apps for refis or loan apps for purchases or to purchase a house. So the latest stats we have according to them state that mortgage applications increased 2% from 1 week earlier. And this is for the week ending May 6, 2022. This is pretty unusual because the share of mortgage applications has been decreasing for weeks now. And this is because, of course, mortgage rates have been increasing greatly. And of course, a lot of people are not refinancing their mortgages, driving down their total mortgage applications week over week. However, that's not what we're seeing right now, even though mortgage rates have been increasing greatly. So overall, mortgage applications, which include refis and purchases, increased 2% compared to 1 week ago. So let me break this down for you guys. I have a lot to share with you guys, including a big increase in the number of people using ARMs, or adjustable rate mortgages, in order to buy houses and refis as well. So they actually break down this report here in two separate sections. That would be the refi index, which is a measure of people submitting loan applications who want to do refis, and also a purchase index, which is a measure of people submitting loan apps for home purchases. That's the one I'm most focused about because the refi index is really tied more directly to mortgage rates. When mortgage rates decrease, more people refi. When they increase greatly, of course, they drop off the cliff. So the refi index decreased 2% compared to 1 week ago, but it decreased 72% compared to 1 year ago. So 1 year ago, rates were approximately 3.3%, and now they're around 5.4% or 5.5%. So it's not a big surprise that the total share of people submitting loan applications for refis has fallen off a cliff compared to 1 year ago. However, here's what I'm most focused about, because this is a gauge about our health of our housing market and what's expected in the months to come. Their unadjusted purchase index increased 5% compared with the previous week and was 8% lower than the same week 1 year ago. Also, it makes sense that we have less people submitting loan applications for home purchases because home prices were 15% lower, and of course, mortgage rates were approximately 2 percentage points lower as well. So it makes sense for people who are submitting loan applications for home purchases. It makes sense that we're seeing fewer right now compared to 1 year ago. However, what I'm scratching my head over is this increase of 5% compared to the previous week. Also, because I've been following this on a weekly basis and reporting this to you guys, this is also the second consecutive month that the purchase index has increased as well. So we have 2 consecutive weeks where the amount of people submitting loan applications for home purchases has been increasing, even though mortgage rates have been rising. So Joel Kahn, who's the MBA's Associate Vice President of Economic and Industry Forecasting, that's a long title, he says the increase in mortgage applications last week was driven by a strong gain in application activity, meaning applications to get a loan from your lender, for conventional and government purchase loans. So conventional loans obviously are loans where you can put down at least 5%. Often people put 20% down for a conventional loan, and government purchase loans would be FHA and VA loans, for example. So in any case, they say we have an increase in mortgage applications even as mortgage rates rose to their highest level at 5.53%, the highest since 2009. Despite a slow start to this year's spring home buying season, prospective buyers are showing some resiliency to higher rates. Purchase activity has now increased for 2 consecutive weeks. So have a look at this. Here's the purchase index over the last 1 year compared to the average 30-year fixed rate loan. The orange line right here is the average 30-year fixed rate mortgage. So 1 year ago, rates were approximately 3%. Now they're over 5%. This blue shaded area is their purchase index. Again, a measure of the people or the number of people submitting loan applications in order to buy houses right now. So as you can see here, looking at this graphic here, the bottom or the all-time record lows more or less for mortgage rates were around August of 2021. Also in January 2021 was also very near all-time record lows as well. In any case, the all-time record lows or very near it was in August of 2021. As you can see here, rates have shot up greatly ever since then. So 2.8% approximately to now over 5% in basically 8 months. So basically what has been happening is what we've been seeing and have been important to you guys is that the number of people submitting loan applications for purchases has more or less been on a declining trend ever since the end of January. So as you can see here, the trend here has been decreasing. We saw a slight increase right here, but it more or less has been decreasing through April 25th. But what we're seeing right now is for 2 consecutive increases, even though mortgage rates have been increasing. I will say this is definitely a short-term trend. We're only talking about 2 consecutive weeks right now. However, it is showing some signs that home buying demand may not be decreasing as much as we expected. I'll definitely keep you posted regarding this because, again, these are short-term trends. Let's not take short-term trends and forecast that over the long run. We'll have to see if this trend continues, and I'll definitely keep you posted regarding that. So one thing I definitely wanted to bring to your attention that I have been reporting to you guys for, I don't know, probably 3 or 4 months now, is that I was personally seeing a higher share of people using adjustable rate mortgages in order to buy houses and to refi. At the start of this year, most people were using 30-year fixed rate mortgages or 15-year fixed rate mortgages in order to buy houses. But what we're seeing right now is a big increase in the share of people using adjustable rate mortgages in order to buy houses and also to refi. So it says here more borrowers, meaning people looking to borrow money from the lender in order to buy a house, continue to utilize ARMs or adjustable rate mortgages to combat higher rates. The share of ARMs increased to 11% of overall loans and to 19% by total dollar volume. Which, by the way, CNBC is reporting that demand for adjustable rate mortgages has surged to a 14-year high as homeowners try to afford this pricey spring market. So right now, home buyers are facing record high home prices, rising mortgage rates, and of course, inflation, which is very close to 40-year highs. And this is causing some people to move to adjustable rate mortgages instead of 30-year fixed rate mortgages. So check this out. At the start of this year, when rates were still hovering near record lows, they were around 3.3%, the ARM share was just 3% of all purchase applications. At 11%, which is right now, this is the highest share since March of 2008. So have a look at this. I did some digging for you guys. I went over this in a separate video as well. But I personally track, again, mortgage applications according to the Mortgage Bankers Association. So I actually found an older survey that they did back in January of 2022. This is for the week ending January 7th, 2022. So let's have a look at this because back in for this week ending January 7th, 2022, the share of ARMs or adjustable rate mortgages was only 3.1% of total applications. Again, now it's 11%. So now we have approximately 4 times as many people using adjustable rate mortgages compared to early January of this year. So have a look at this because this is the reason why. So when we look at the average 30-year fixed rate mortgage back for this week ending again January 7th, the average was 3.52%. Still very low rate. Again, the all-time record low was around 2.7%. So the average 30-year fixed was approximately 3.5% during this time. Also, the average for the 5/1 ARM, meaning the rate is fixed for 5 years, then it becomes adjustable for every year after that. That's called a 5/1 ARM. That rate was 3.03%. So the difference there, or the spread between the rate on an ARM or a 5/1 ARM and a 30-year fixed rate mortgage was approximately a 0.5 percentage point. Not a big difference. That's why we see the share back in January was only 3.1%. But have a look at what's going on right now. So right now, at least for the week ending May 6, 2022, the average 30-year fixed rate mortgage was 5.53%. In contrast, though, the 5/1 ARM was at 4.47%. So in other words, more than 1 percentage point less compared to a 30-year fixed rate mortgage. So people are looking at high home prices, rising inflation, very high mortgage rates as well. They're looking at, hey, should I get a loan for 5.53% or should I just get a 5/1 ARM at 4.47%? Because if I use an ARM, and therefore my housing payment is going to be less than a 30-year fixed rate mortgage. So let me give you guys an example. So according to the Mortgage News Daily, they give you averages for mortgage rates on a daily basis. The average as of today, which is the 11th of May, for a 30-year fixed is 5.41%. And the average for a 5/1 ARM is 4.57%, which, by the way, you can get a 7/1 ARM or 10/1 ARM, meaning your teaser rate is fixed for 5 to 7 to 10 years, and then the rate becomes variable thereafter, meaning it adjusts to current market conditions. In other words, if mortgage rates continue to increase, so will your housing payment and so will your mortgage rate once you reach beyond this teaser rate. So in any case, a 30-year is at 5.41% and a 5/1 ARM is at 4.57%. As you guys may have noticed, the spread has been decreasing. So right now the spread between the rate on a 5/1 ARM and a 30-year fixed rate mortgage is approximately 0.8 percentage points. But again, going back to this report from the Mortgage Bankers Association for the week ending May 6th, which was last week, the spread was actually greater. So for the 30-year fixed rate mortgage, 5.5%, a 5/1 ARM was 4.47%. So over 1 percentage point, and now according to the Mortgage Bankers Association, it's actually less than that. However, because mortgage rates have been increasing greatly and also home prices have been increasing greatly as well, I would not be surprised if the share of people using adjustable rate mortgages continues to climb, even though the spread has been decreasing. So anyways, I want to give you an example here though. So the payment on a 30-year fixed rate mortgage at 5.41% would give you a principal and interest only payment of $2,249 per month. If you're going to use a 5/1 ARM, that payment would be just over $2,000 per month. So in other words, people looking to buy a house right now are looking at a 30-year fixed at $2,249 per month, or they can save approximately $200 per month by getting a 5/1 ARM, which in my opinion is much more risky because after that teaser period, which is 5 years, where again your rate is fixed and then it becomes variable thereafter, what if mortgage rates continue to increase? What if they're not 5.4%? What if they are 7% 5 years from now? Then after that teaser period, your mortgage payment is going to be increasing. On top of that, what if home prices decrease within this teaser period? If they decrease and you're going to be underwater on your mortgage, you're not going to be able to refinance your mortgage. I know a lot of people say, hey, just use a 5/1 ARM or 7/1 ARM. You can just refinance later. But you have to have equity in your house in order to do that. Also, you have to prove to the lender that you also can afford the payment as well, even though you have a current rate. So you basically have to apply for a new mortgage if you want to refi. So in my opinion, because we don't know what mortgage rates are going to be like after this teaser period, and also we don't know what home prices are going to be like after this teaser period, in my opinion, it's a big risk. So that's something definitely I want to bring to your attention because we're seeing more people using adjustable rate mortgages, which again is approximately 4 times as many people using adjustable rate mortgages compared to earlier this year in January. Because the share of people using adjustable rate mortgages right now in order to apply for loans, this is one reason why their purchase index has increased as well. One more thing I thought it'd be definitely worth mentioning is that when I hear adjustable rate mortgages, I think of 2008. However, 2008 compared to now, especially when we're talking about adjustable rate mortgages, is completely different. So here's what CNBC had to say. ARMs offer lower rates, which can be fixed for terms like 5, 7, or 10 years. I would call those teaser rates. In other words, your payment and also your rate is fixed for a short period of time. 5, 7, or 10 years, for example. ARMs are also fully underwritten like fixed rate mortgages. In other words, an underwriter looks at your file and also determines whether you can afford the mortgage payment. They also require a down payment, but this was not the case in the early 2000s when poorly underwritten interest-only ARMs with short teaser periods were blamed for the epic housing crash. So comment below with your biggest takeaways from today's video. Also, if you got any value out of today's video whatsoever, then please hit the like button. I greatly appreciate that. Hope you have an awesome day. Look forward to seeing you on the next video.